Hey, Facebook family. Thanks for joining us yet another Friday for our Friday Facebook Lives, all of the month of April for our Financial Literacy Month. Today, I'll be moderating. I'm Joy. I'm a marketing coordinator. And of course, these guys are advisors. George down there, Andrew right here. So today we're going to be focusing on investing and, typical questions that come up in our office and typical things that we like to give our clients in terms of information we need them to know about investing. So I guess we'll just start it off with the most basic question. What is investing? Andrew, you want to take it first? Directly to my left.
Yes. So investing basically is when money works for you, and you put. Obviously, you have to save in order to be ready to invest, but it all comes down to smart money. Sometimes we could kind of confuse them investing with having a business. Again, when you invest, you expect that the money will grow. Either it will be like a short term or a long term, but normally you should pay attention, but you should put any more effort toward that. And there might be different type of investments, but all it comes down to a very basic idea that you should believe in smart money and money should grow for you. Unless you, George, have any other ideas?
Yeah.
Yeah. So investing, like when we're dealing with clients, obviously it's more on the monetary side, but I look at it more holistically too. Is it's putting towards something with an expectation or result. So in that capacity, what we put could be time, money, whatever it might be. So if you think about a business, it's not always just funneling money. Sometimes if it's your business, you are putting your own time into it.
Also,
an effort in order to have the achievement of a successful business. So when we invest, it's about an achievable goal in my eyes. It's like, so when we look at investing, it's if we're putting capital towards it or time, whatever it might be, with an expected result. So it's like something that you would want or what you think is going to be in the future.
Okay. So I had our next question as what investing is not. But I guess I'll restructure that. So based off of what you guys have just said, what would you tell people to steer clear of? Like, I know there's a lot of perception out there, like they see the movies like Wall Street and they just immediately associate that one thing, that one visual with investing.
Wait, are we saying that's not accurate?
Well, just let us know what's really.
And very like a quick example that I can think that we hear all day is for example, when people want to invest in real estate. Nothing wrong with that, absolutely right. But then again, it comes down to you invest, but the money is not coming back to you. Like, I'm not saying right away, but still, you have to put a lot of time on that, a lot of effort, a lot of headaches, and that is kind of not quite the same thing.
So take the first question, like, so if we say a house is an investment, right? Mm-hmm. So when people say, I'm going to buy a house as an investment, if we say that investing is, putting money or time towards something that has an achievable result, that if you're buying a house as an investment, like, what does that look like? So when people say they want to buy a house for investment, I'm like, well, how is it an investment? Like, what is the future that you see this house being? And a lot of times people say, oh, I'll rent it out, etc. And like, that's not that it's an unrealistic expectation. It's just to get to that point, to actually turn a profit takes, maybe 10 to 15 years before it even starts to become profitable in your favor. So that's why I always say, I challenge people when I say, oh, well, what are you investing for?
If not even more, because usually a mortgage is average like 25 to 30 years.
Yeah.
So it might turn. Always, if you're lucky that you're gonna rent it out all the time, always, unless something happened like it goes in value, but that's not always the case.
So like, what isn't an investment then, or I always look at it, it's like, well, again, what's the purpose or the end result of this? So say some people I've talked to, like, oh, I want to invest to put a down payment down on a house. Well, what are you expecting to do with this? And it's like, okay, I want to put $5,000 so it grows to $10,000. Well, you look at rate of return, that's 100% rate of return. How are we going to do that in a controlled manner, so to speak? Because I have no idea what the market's going to do, or even if you're investing in cash, an online savings account is 2.2%. Take a while for that to grow. So it's like, is it investing or is it savings? And just being able to disseminate the information itself is attaching to the goal. And that's why I always look at, well, even if the goal is 5 years, the best way to get there may not be rate of return. It may just be putting money or capital towards it. Because again, the expected result is that we have X amount of dollars ready to go for a down payment. And that is achieving the goal. So when you look at investing, it's more so taking a step back and realizing, well, how long do I have to do this? What is the future? Like, what am I trying to have at the end of this mission or this end of this goal instead? So there's a lot of things that aren't investing for sure. But I think, we look at investing so broadly, even finance in general is so broad. So just being able to be more specific about what the goal is instead and kind of starting there.
Okay. So I'll take the tail end of what you just said. So before anybody starts to invest, what other things or what questions should they be asking themselves, and what things they need to consider? And I'm pretty sure there's at least 5 things or more that they need to do before they start.
Before they start, well, first of all, having a goal. Absolutely, having a goal and a plan how to get there. Then we can break it down. To invest, you should save. To save, you should budget, and to budget, you should create good spending habits. So there are a lot of steps to consider, not necessarily for those people that think that you should have money in order to invest. That is not true, because you can start with even like a very small amount. Important again is to have a goal, because we are more prone to stick with that goal and to work toward the plan that you have. And again, yes, sometimes it takes time when it's about small amounts, but it is totally doable.
Yeah, so the goal itself is a big focal point. And then once you define the goal, it's really more so how much is that goal going to cost. But even then, if it's like, again, going back to a house as an example, you don't necessarily need to save $300,000. You need to save enough for the down payment. So it's like, okay, how much do I need to save? The expected end result for a house is you own the house outright, but you need something as a starting point. So it's like, okay, how much do I need? How long is this going to be for? It's a 30-year mortgage. That could be a mortgage 30 years. However, still a separate goal before that is okay, I need $10,000 or $30,000 for the down payment, whatever it might be, and then that's a separate goal. So it's like, oh, that might be 5 years. Okay, so now we know how long we have for the down payment. The goal is to have a down payment for a house, and you kind of reverse engineer everything backwards from that point. And then it's okay, how much do I need to save to get to this point? And if we're going to include things like rate of return, are we calculating it based on cash, or are we going to invest in the market? Because if we're investing in the market, it also could go the opposite direction from our goals. So if we look at it that way, then all of a sudden we might not even have our goal. So that's why you have to be careful about the amount of risk you're willing to take. So that's another consideration, is the risk you're willing to take in order to achieve said goal. If you want to look at it in the long run, if you don't want to take a lot of risk, that could actually delay your goal. On the flip side, if you want to take more risk for a shorter term, that could delay your goal just because of things like market volatility.
Another thing that I can add, before you invest, try to be as much educated as you can. One thing that investor does really well here is like giving a lot of information upfront, so people can do the right choices when it comes to investments. And with the right choice, I'm not saying like picking the right stock or, like knowing right away, like, okay, this is the best way, but just understanding that how it works, be diversified or working with the right people and so on.
Yeah.
Okay. So once a person has a goal, they understand how much money they'll need to set aside for said goal, what their time horizon is, and how much risk they're willing to take. How do they decide what's the appropriate investment vehicle for them? Or we could start off with what different types are even out there.
Yeah, so the investment vehicle is typically, I always look at it like an actual car. It's like, so the vehicle is what's going to get you to the destination, right? So For retirement, the vehicle would be an IRA or a 401k.
Which stands for?
So IRA is an individual retirement account.
Okay.
So that would be your vehicle, because that's the best way to get to retirement is by saving in a tax-deferred account. It's not the only vehicle you can use, but it's the most efficient one, right?
Okay.
So we look at matching it up with the goal. So if it is down payment for a house and it's a short-term goal, well, our vehicle will probably just be a bank account, right?
Okay.
Because we want to make sure that it is safe. It's not going to have much market fluctuation, if anything, and then also have at least some rate of return. Maybe it will keep pace with inflation, or at the very least not get eaten into by inflation as much. So it would be like a type of vehicle. So those are like the vehicles, and then what's inside the vehicle is a whole nother type of thing. And the reason I use actual cars for this type of analogy is because it's similar. It's like, okay, when we look at safety in a car, when we look at safety in our IRA accounts or our 401ks, it's like, okay, well, if we're too safe, we might not get to the destination as quickly. If you have a super safe car, maybe that means it can only go 40 miles an hour. Well, that's not really what we need, but it might be super safe, But again, if it's one of those super fast ones, well, maybe things don't go too well if we're going too fast. So I look at it the same way as like, what safety features do we need inside an IRA? Well, we definitely want airbags in case something catastrophic were to happen, like a 2008. So that's even why with the younger clients that I work with now, we still have a portion of safer investments in there. It's not 100% the stock allocation. But those are the vehicles. It's just like what's going to get you there the most efficient way. But then inside the vehicle is a whole nother ball game. So I don't know if that was a follow-up question. I didn't want to jump into that part.
Also, it depends from person to person. Some of them might have the opportunity to have a pension plan from their job, or a 401k, a 403b, a 457, depending on for which they work, who they work. Other than that, as George said, can be IRAs, different type of IRAs, actually two types. And then on top of that, some taxable investing accounts. Then we obviously can manage here beside the 401ks. So that's another thing, that there are different types of vehicles, but then it depends on your case. You might be eligible for certain if you work, and if not, there are options definitely.
Yeah, like not everyone has the option for a retirement plan
Correct,
to work,
correct.
so they don't have the keys to that vehicle.
That's true. Yeah, exactly.
Yeah.
So for a simpler goal, like, well, saving for a house may not be that simple, but
Right.
maybe saving for a vacation.
Okay.
You said that person would open up a savings account. That's probably their best bet, because
Correct.
it's more liquid and
Right.
they can work with it. But for the more complicated stuff, you say your IRA, 401ks, ETFs. Well, that's not the same thing.
Well, that's the
So
inside.
that would be like
The engine
So,
of the vehicle.
right. So like think about if you want like what's inside your vehicle. It's like, okay, well, what's efficient right now? Let's use like a hybrid car as an example. They're more efficient when it comes to you get more mileage out of them, right? So same with ETFs, they have lower costs. So as a lower cost, we can get more theoretical mileage out of them for clients. We keep for us here, for those that don't know, we use Betterment as our custodian. So we keep the investment costs lower so that we have more we can spend more time on things coming up with your actual goal plan, your cash flow analysis, things like that are actually going to help you get to your goal quicker, because it's not just investing or picking the right investments. It's literally everything else that encapsulates it all that's going to determine the level of efficiency. Because if you just have an ETF but you're not saving, it's like, well, you need to put gas in the car, even if it's a hybrid. You can't rely on only the electricity. So that's what would be inside the vehicle itself. So if you're going to use like vacation, obviously it's still going to be cash. But if we're looking at retirement, then it's like, okay, well, what other features, like what do I need in order to continually make it a more efficient process? So that's when you look at exchange traded funds or mutual funds. I mean, if you do want to do individual stocks, I mean, that's more like you're driving a stick shift. You have to make sure you're paying attention, or you can really mess something up. So it's not to say that you can't have a more manual process with it. But a manual car is a lot easier than an actual manual portfolio. You need to be paying way more attention to your stocks than a manual car. Maybe I don't know. Once you get the hang of the manual car, I guess it's pretty easy. But if you're just starting off, you mess up your transmission.
That's true.
Yeah, which was bringing me to my point. So I was saying saving is probably easier on a just individual basis, but with investments, should a person be managing their own investments, or should they be using a professional?
And we're biased.
Well, I guess like with everything else, like we try to do ourselves. I mean, yes, there is a lot of information out there nowadays, and then you still will do it, but you will still doubt yourself. Did I do it wrong? Did I do it right or wrong? So
Emotions come into play.
not just that, but we're talking about your future, right? We're talking about your money. So, and what I meant is like even something simple. I don't know. We Google everything now. How to name something. How to put something in our car.
Even for doctors, like we Google our symptoms, right?
Mm-hmm.
Correct, but yeah, exactly.
So it's like here's the thing is, why do we Google our symptoms, or why do we try to do things? That maybe it's saving time to an extent, but I think the biggest thing is saving money. Like I don't want to necessarily have to go to the doctor and pay for something that maybe it's just a headache, right? But here's the thing is, if we keep diagnosing or self-diagnosing our problems, sometimes that means if we had just gone to the doctor earlier, we would have saved a ton of money.
Yep.
So same thing with an investment advisor is we can sit here and say, yes, I can do this on my own, but I have to spend time to do that. There's still transaction costs with a lot of things, so you still might pay smaller amounts, where if you just gone to the professional in the first place, you might have saved thousands, over the long run anyway. So it's the same concept. Is the fact that there's information out there is so great. I think it's awesome that we live in the era we do, but in the same vein, that can breed a lot of potentially negative consequences because we may not be paying attention to certain things. And it's like, oh, well, maybe we misdiagnosed our own problem. So even with like the car,
even a filter when it comes
put it in wrong, God
if
forbid.
something happened, it's just a filter, so that's fine. But think about that. There is only one thing in life that we cannot buy. What is that? Time. So to your point, once you put time, that means that you are putting more than money, right?
Yeah.
So we should delegate things, and then at least we don't have that doubt in our mind. Okay.
So that goes back to the first question. Like what is investing?
Mm-hmm.
So when you're doing your own research, you're saving money, right?
Mm-hmm.
But you're sacrificing your time.
Correct.
So I mean, the old adage, like where time is money, it's like it equates to a value. If you're putting in 2 hours a week for researching investments, there's nothing wrong with that. But as your money grows, you may need to be more involved. So you may be spending more hours involved. So it's not to say you can't do those things. It was like, what else would you rather be doing?
Yeah.
If you're
we're not talking about quality here, as you said, because
right.
obviously a financial advisor will add value.
Yeah.
It should add value. We're talking just like, can I do it or not? Yes, you can, but there are a lot of what ifs after that.
I'm sure there's tutorials to do your own surgeries online. I'm not going to do it myself, though.
I was watching this guy with the plumbing thing. It's so easy. Only the tools were like $2,000, so I don't know if it's easy anymore. Yeah, I mean, it looks easy.
Costs are starting.
You need this, you need that.
Right.
So yeah.
So I think to go back to your original point or question is, I think everyone should use professionals in all facets of their life for things that they are not professionals in. And even then, professionals still go to other professionals. If I'm a doctor, I can't just check myself out. I also have a doctor. I talk to our clients too. So I don't manage my own money either because I don't. Number one, I don't have time to do that. And number two, it's easier and actual. For us, like if it's with Betterment, it's actually better for them doing it because like I'm not attached to it emotionally. So professionals still use professionals too. Think about lawyers they'll usually get a lawyer to represent them too. Great. So it just as soon as you start talking about investing, it's like, oh, I can do it myself. It's like I get it, but plenty of professionals out there still use professionals in their same field to accomplish the same goal, and it's just so they're not attached to it emotionally. They can have a more delegated approach to it.
So I'm pretty sure there are a lot of working professionals who are out there and have 401ks or any other kind of on work-related retirement plans who aren't managing them, but they know that they have it and they're just contributing to it. Should they still get advice from a professional on an account like that, even though they're not like watching it? Like,
yeah, 401ks are.
They get statements, so
right.
they would come in and.
So yeah, I mean, I would still recommend, I guess, one of those things where you can't necessarily. That's like if you're forced to take a train, right? Like that's your vehicle at this point, a train, because it's going to go one way. You might not have other options, especially in a 401k. So we just need to make sure that is the best train to take. So you can come to us. We'll say, okay, well, here's the route options that you have. This is the most efficient route. And I think that's like my best analogy for that one is like, look, you may not have options. Things are on a track. Let's make sure you're using the right one though. You know, we don't want to send you up to DC just to come back to Baltimore. It's like you can take the light rail, you know? So just making sure that, it's the most efficient option that you have within your plan. So, and we can still do that for clients too, just to make sure that they're not wasting too much time, or if there are internal costs for their funds, that they have like the most efficient or cheapest option, depending.
That's really important because fees add up.
Yeah.
And I know in previous jobs, like they just told you to check things off. You really don't know what you're checking off. You can have
sign your life away.
All stocks or all bonds. It's just like you just don't know, and it's not necessarily your fault if you're not, literate enough in that aspect. But there are resources out there, just like Invested. I mean, this is a shameless plug, but there are other resources out there too.
Shameless plug on our own page. You're here anyway.
Just to make sure that you're setting yourself up for your best future. So what the next question is. So I guess that could just lead into Invested. Well, what is Invested's approach to investing?
So, I mean, asset allocation.
And what is that for the people who don't?
So asset allocation is just it's modern portfolio theory. It's been around since the 1950s. It's very forward-looking when it comes to the markets, and it makes sure that you have basically general global allocations because we have no idea what's going to happen, right? So the best thing that we can do is, theoretically hedge our bets against all the broad parts of the market. But in order to do that, we still need each piece of the market itself. So that's the most efficient way to get there because we have no idea what the market's going to do. But even furthermore, once we develop asset allocation itself, then it's tying it to the goal. So I always say we start with the goal, right? And then we can reverse engineer backwards to make sure we're on track. So when you hear like the hypothetical rate of returns of 7 or 8%, those are typically based around asset allocation models. But everyone's supposed to go buy Apple or Facebook or a stock. But that's not necessarily going to get you anywhere because that's not investing. You're just buying a stock. So
it's investing without a plan.
Yeah, it's dangerous.
Like it might grow, but then what's next?
Right.
What's going to be the next Apple or growing stock? So
yeah. And so I guess Invested's philosophy. I mean, when we have meetings, I say we do goal-based investing. Our goal it's not just about making money. It's achieving a goal. Mm-hmm. So that's much more important than just making money. Like you said, if you buy a stock and it grows, well, okay, now what? What's the purpose of it?
But on top of that, not just the asset allocation or diversified portfolios, but even like more simple than that, Invested will add value because, as I said, education. Mm-hmm. Also, like if you were kind of thinking that, am I doing the right thing or is this a goal? We can confirm that for you, or we can confirm your financial situation. It might be even better than you thought. It might be even worse. So what can we improve? And another thing is no minimums to start. Okay. So there are not just the structure, the way how we invest, but even other things to get ready to invest.
Yeah.
So I guess I'll take it to some other like basic questions. Why do you guys think that more people aren't investing or haven't started investing? Because we know it's in this community, it's very important to start investing as soon as you can. So
I think the industry itself is very complicated. those fine prints,
Mm-hmm.
that keep people away, like the small letters. That is one reason. The other reason is whatever might have happened, like in case like 2008, people got scared and they didn't get the full point of investing. They just thought like, oh, I lost money.
Right.
Yes, the market went down, but you lost money if you bailed out, if you
Right.
sold and got out, because maybe there was no plan. But what now is different is that you come up with a plan, we raise expectations that things like that might happen, but then if we stick with the plan, and then the investment has a full meaning of like, okay, I'm invested, I will stay invested until the end of my goal. So because of those cases, I guess most of the people are scared also, because they weren't educated enough.
Yeah, I mean, education ties into a lot of things.
Yeah.
Fear, for sure. Greed. I mean, some people aren't invested because of greed, because they actually
Very
want the
good
market
point,
to
yeah.
crash so that they can take advantage of it. But that's not, to me, that like some people think, oh, I'm being cautious. I'm like, no, that's greedy. Like you're trying to wait for the market to drop in half so that you can double up your own money. But the likelihood of that happening is so small. If you were that greedy, you'd actually just invest tomorrow, because that has shown to have higher success rates of earning money in the long run. But I actually equate that to greed, because people are hoping for a 10 or even 15% drop. It's like, well, we don't know when that's going to happen. Like, if you're that adamant that it's going to happen, then you're a greedy person. Like that's what I look at. It's like, what is this extra 10% going to do for you? So I look at it kind of like a reverse thought process when it comes to that. But yeah, I mean, education is a huge piece, because if people don't know any better, I think that's a big thing. We also looked at the stat the other day. It's like most people don't start investing for retirement until 35. So it's like, well, why is that? Okay, because some people prioritize paying off things like student loans. And they think, oh, I can't save in my 401k, or I can't save for retirement and contribute to student loans. But that goes back to the education piece. Like, you can do both, I mean, look at if you contribute to your 401k plan through work and they have a match. Like, that's number one, that's free money.
Yeah.
But number two, if you're doing pre-tax or traditional contributions, it doesn't affect your paycheck as much as people think. So if we sit here and did mathematics and said, oh, I'm going to contribute 10% of my salary, and it's $5,000 or $10,000, right? That's what we look at. But the true effect on your paycheck is not that much for the year, because it comes out before taxes. Mm-hmm. So we get that stuck in our mentality, is it'll come out based on the after-tax value, but that's not true. So what it does is lower our taxable income, and then we pay the taxes. So your paychecks aren't really affected that much. So sometimes we think, oh, I can't afford to do that, but it's like, no, you can, but we don't know what the numbers actually look like, so we're scared. We know enough math to say, well, 10% of 50,000 is $5,000. I can't afford to do that. But then we really aren't looking at, again, we're not educated enough to realize it's not a hard line $5,000 that's coming out of your hands. No. But I think a lot of things will prevent people from investing. And not knowing where to start, I mean, goes back to educated.
Yeah.
Or there being too much information. That's overwhelming too.
Mm-hmm.
Okay, so for someone who's still on the fence about whether or not they should be investing, what's something you could say to them if they're watching right now? Why invest today?
Hi. Why invest today or when?
No,
Why
invest today?
I don't know yet. I don't know about their situation, so they should come in for a meeting so we can help them determine if they're ready to invest. That's my plug for us.
Another reason is that, as George said, there is no such thing as the right time.
Yeah, I mean, when it comes to like market timing,
Mm-hmm.
Statistically proven that you should start or be invested. There is no such thing as this is the best time.
Right.
If someone waits a year and then invests, but like hoping that's going to be the perfect time, and if it start investing today, will be that probability that the probability will be like it's better to start investing as soon as possible.
Okay, if you're on the fence, I think first you should understand why you're on the fence, right? Is it emotional? Because if it's emotional, that's not necessarily the biggest justification for being on the fence. If it's, I'm not sure if I have enough money, I think that's justifiable. Like that is like, let's make sure you do have enough money to actually invest, because even with our clients here, we want to make sure that they have an emergency fund in case anything happens, and then they'll be ready to invest. So just having cash set aside that's in excess of whatever you're going to be saving for goal-wise or investing for. So I think looking at why you're on the fence in the first place, if it is because of potential returns or emotions or anything like that, then that's when we might have to be the mama birds and push you out of the nest so you can fly. But just look at why you're on the fence in the first place and figure out what your goal is. If it's that important to you, align the investment with your investment objectives with your goal. So then hopefully it'll be an easier process. And you don't have to do it all at once either. If you are worried about volatility, do it over time. If you had $5,000 sitting there ready to invest, but you're nervous, then just do $500 a month and dollar cost average it in. Because if you're dollar cost averaging, that's like the one way to remove market risk to an extent. If the market's going to go up and down, then if you're contributing $500, then when it's down, you're going to get more shares. When it's up, yes, you'll get less, but over time you'll have a lower cost. You don't have to feel like you're that tied to what the market's doing if you put all the money in. Because if you do that goes back to the emotional part. It's like some people can't separate. That's like their money. It's like, all right, let's do it over time. Take the stairs down this fence instead of jumping off.
As we always say, we are here to keep you from yourself.
Yeah.
Keep you away or separate from your emotions.
Yeah.
Okay. I guess we can conclude with your top do's and don'ts for investing.
All right. Yeah. I don't think I have anything else to add, but start as soon as possible. Yeah. And the starting point will be having a meeting here with us, totally free. We'll be more than happy to take a look at your situation.
Yeah. Just make sure things are in line with your goals, because it's about achieving a goal, not just making money. Bitcoin is not an investment; it's a commodity at the very most. So people that are trying to sell you that as an investment, it is not. And I will gladly argue with them if you want to, but don't listen to the hype or the media or anything like that. It's going to either make you make the wrong decision one way or another. If you're seeing something go up and bring up Bitcoin again, it was at 20,000. Now it's like 5,500, and a lot of people missed that train. A lot of people bought in and lost a ton of money. So if you're seeing something, you're not the only one seeing that information. There's no secret information that someone else has. You're mostly seeing the same exact thing as someone else. So don't think you're acting on proprietary information. Try to focus on your own situation and ignore everyone else, because you need to make sure that what you're doing is right for you. It might not be right for everyone else, but that's trying to stay in line with your goal. So try to turn off the noise, what we say usually. And just be disciplined about it. And feel free to use professional advice. Like Andrea said, we're here to meet with you if you want to review your own situation.
You think that sums it up?
I think so.
Did we miss anything, Joy?
We should leave some information for next Friday.
Oh, you said leave information for next Friday.
Follow us.
No, it's Tuesday.
It's Tuesday.
We're done Tuesday.
Oh.
Because so we'll see you on Tuesday because last day of April.
All right.
Yeah.
Sorry.
It confused me too. Oh, that's why we have a plan.
Yes.
Joy.
Always
See?
have a plan.
You got to delegate.
Okay.
Joy keeps us in line.
I was not sure.
Yeah. But if you have any questions, feel free to post them here. We can get to them at another time. Otherwise, continue to follow us. If there's anything that you personally want to see content-wise, let us know, and we can get that out to you. But thank you for watching, and
Thanks for watching.
See you Tuesday.
And one more thing.
Oh.
We want to invite you guys out to Finances on Tap this upcoming Monday. This is our confirmed day of April 29th at 6 p.m. Between 6 and 6:30 will probably be our mingling and drinking time. But the first 10 people to arrive, drinks are on us. So we hope to see you there. Invite a friend. Come. It's going to be an interactive presentation. We got some cool, nice demonstration during the presentation. And we also have something to raffle off. So come on out next Monday at Diamondback Brewery. Finance is on tap with Invested. So have a great weekend. Hope the weather's nice and you can enjoy it. And be safe, guys. Until next time.
Thank you for watching.